We want to talk about your overhead what? Variances class. Now number 3. Your variable overhead. Variances. Your variable overhead variances will be two main ones. You have your variable overhead expenditure variance, which I will simply refer to as that. Your variable overhead expenditure variance is simply your actual hours, your budgeted or standard overhead absorption rate minus your actual overhead absorption rate. This is your actual hours. OAR is your budgeted or standard overhead absorption rate. Standard variable overhead absorption rate. So this is in shillings per hour. This is your actual variable overhead absorption rate, which is also in shillings per hour. Now, a variable overhead expenditure variance is a variance of actual hours but at standard what? Overhead absorption rate, and you compare it with the actual variable overheads that was done what? Paid, that was incurred or paid for. So we can start and do this question. Remember, they are telling us to reconcile your actual hours were 28,500. Your OAR is 20 minus your actual variable, which will be 520, divide by who? 28,500. 28,500. Then variable overhead efficiency variance, which we denote as VOEF, efficiency variance. OAR, standard minus actual what? Hours, actual hours. Let's go and see. Now, the standard hours, you already have them somewhere. Your standard hours were somewhere. And here they are. Your actual hours, you still have them. So your OAR will be 20. Standard hours were 3 by 9,000 minus actual hours of 28,500. Of 28,500. 500 of 28, 500. This will give you 30,000, which is adverse. $50,000, which is favorable. Therefore, your variable overhead cost variance is the summation of your expenditure variance and your efficiency variance. $50,000 favorable plus 30,000 adverse will give you 20,000 what? Favorable. Number 4. Number 4. Fixed overheads variance start with the fixed overhead expenditure variance how do you get your expenditure variance? You simply say it is the difference between budgeted fixed overheads and actual fixed overheads. It is the difference between the budgeted and the actuals. The budgeted fixed overheads are there. These are your actual fixed overheads. Where your budgeted fixed overheads for the whole year were 14,400,000. You want for 1 month minus the actual fixed overheads that were incurred, which is 1160. This will give you 40,000, which is favorable. Fixed overhead, volume variance is given by your standard fixed cost per unit, your budgeted quantity minus your actual quantity. Your budgeted quantity minus your actual what? Quantity. To determine your budgeted fixed overheads, let me come back there. You simply say it is your OAR per hour. You multiply by your budgeted hours. And your budgeted hours are of budgeted production. They are of budgeted production. Okay. Therefore, you're going to take your standard hours of 3 your budgeted production was 10,000. So your budgeted hours should have been 10 what? 10,000 hours, 10,000 hours. Okay. Your budgeted fixed overheads are here. 14,400. You divide by 12 is equal to an OAR you don't know, but you know your budgeted hours were 30,000. Therefore, your overhead absorption rate per hour, will be 30. That will be 30 per hour. Actually 40, not 30. 40 per hour. So therefore, your standard fixed cost per unit will be your OAR per hour. You multiply by your standard hours per unit. Your OAR is 40, your standard hour per unit was 3, so that should give you 120. So therefore, your fixed overhead volume variance is 120 into bracket budgeted quantity of 10,000 minus actual quantity of 9,000. The actual sales was 9,000. That should give you 120,000. It is a what? A quantity variance. So you had budgeted to produce 10, ended up producing 9. Therefore, that is what? Adverse. Then your fixed overhead cost variance is simply the summation of your efficiency of your expenditure and your volume. 40,000 favorable plus 120,000 adverse. This is 80,000. Adverse. Right. The fifth variance is the sales variances. The first one is sales price variance. SPV. Your sales price variance is simply the actual quantity sold, standard selling price minus actual selling price. So this is the standard selling price or the budgeted selling price per unit. AP means your actual selling price per unit. So it is a variance of what you had budgeted to sell in shillings and what you actually sold in shillings, but for the actual quantity. The actual quantity sold was 9,000 units. Your standard selling price per unit is 880 minus your actual selling price, which is 900. So again, we calculate this. 20 times 9,000, 180,000. This is favorable. Why is it favorable? Because you had budgeted to sell at 880, actually sold at 900. So that is good. Then you will have your sales volume variance. The sales volume variance, and your sales volume variance is given by standard profit, budgeted quantity minus actual quantity sold. Actual quantity sold. Your standard profit is simply the difference between standard selling price and your standard costs. And standard costs, okay? So therefore, your standard selling price is 880 minus your standard costs for materials is 200 per unit and 150 for material B. Labor is 270 per unit. Variable overhead is 60 per unit. Fixed overheads will be 14,400. All that you divide by 12 months. Then you divide by a budgeted production of what? 10,000. Of 10,000. So therefore, your standard profit will be 80. So therefore, your volume variance will be 80. Your budgeted quantity was 10,000 minus an actual quantity of 9,000. An actual quantity of 9,000. So this should give you 80,000, which is adverse. Why? You had budgeted to sell 10,000 units. You ended up selling 9,000. Then lastly, your total sales variance, which is equal to your sales volume variance plus your sales price variance. Your volume is 80,000 adverse plus your price of 180,000 favorable. This should give you 100,000 favorable. 100,000 favorable. So when you reconcile these, you take your actual profit, you less your adverse. You less your adverse. Specifically, this is what you less. Your cost, you less all your cost variances. Your labor, your material cost, your labor cost, in case it is adverse, you less. Your variable cost of favor that is favorable, you add. Adverse, you less, will give you your budgeted profit. It will give you your budgeted profit or loss. And you know that your budgeted profit and loss was how much? 12,400. The original profit or loss was 12,400. It was 12,400. And that is how you reconcile costs using operational what? Variances. Remember, I've said you'll take your actual profit, consider these main variances, the cost variances, that cost, and that cost, where that cost variance, and lastly your total sales variance there. That is what you consider. That is what you consider when you that you're going to add or less to your what? To your actual profit to give you a budgeted profit or loss. I think it was 12,400,000. It was 12,400. That way. It was 12.4 million. Now that we said, we should do what? We should include all the zeros. All right. So what we've done today is use of operational variances in reconciling original with actual performance. Okay. So when we meet in the next lesson, we are going to talk about advanced variance analysis, planning and operational analysis, which basically I have given you the basic variances, but we have usage variance can further be split into two. Labor efficiency variance can also be split into two. Your overhead volume variance can also be split into two. And also your volume variance can also be subdividing. So those are advanced variances. So in the next lesson, we will talk about advanced variances. So from me and on behalf of Manifested Publishers, goodbye and God bless you. See you next time.